Hello, my name is Alex Merced from alexmerced.com. And what I want to talk about today is sort of how an economy grows and how it shrinks. And I think the easiest way to think about this is sort of to compare it to an investment portfolio, because honestly they're actually very correlated. But when you have an investment portfolio, what happens is that you're going to buy stocks, you're going to buy bonds, and basically when you do that, you're placing several bets on which companies are going to do well, which companies can pay off their debts, etc. And if more of your bets are right, the value of your portfolio will grow. And if you make more wrong bets, your portfolio will shrink. That's essentially how the economy works. Except instead of one person making all the bets, we are all making several bets. Every time we donate to a charity, every time we start a business, every time the government builds a road or someone privately builds a road, they're making a bet on the productive use of those resources. And if it turns out that those resources were productively used, there should be more afterwards. Okay? Basically, someone starts a successful business, they're going to have more than they started out with because of the value that's produced. If someone donates to a charity that truly helps, there will be more value produced than the resources committed to that project. Okay, we create a road between two places that actually increase productivity between those two places, there'll be more. Now, so in that case, an economy grows when more of these bets pan out and they work out. Is there a magic to that? No. Basically, how the quality of bets we make is going to be based on the information we have. The more, as an entrepreneur, I do my due diligence as far as who my competitors are, is there a demand for my product, etc., the more likely that business may work out. The more research that a charity does on the underlying problem that they're trying to solve and what are the different options and how to solve it, the more likely they're going to be able to identify a good way to solve that problem and put those resources to good use. But there's several other signals that are out there that help you make these decisions, and one of those is prices. So what happens is that if a price of a particular resource is too cheap, then certain business models, and when I say too cheap, I mean that the price has been manipulated through some basically government policy that has made the price lower than it otherwise would be. What's going to happen is that certain business models may look more profitable than the other would be. They make more sense than they otherwise would be, and now I'm making a bad prediction. But because these other signals that factor in me pricing whether this makes sense or not are distorted. So then this could easily result in more bad predictions as far as which business, which charity, which road makes the most sense, and result in bad predictions, which when you have a bad prediction, when you make the wrong business, donate to the wrong charity, you end up with less than you started out with. Because if you invest $100,000 into a business and the business can't sell its product, can't grow, you just lost $100,000. The world is less wealthy than it was before. So when there are more projects that lose than make money, basically more bad predictions, the economy shrinks. Okay? So when you see a recession, all it means is we're just seeing the result of several bad predictions that happened in the past coming to roost. What kind of things affect those predictions? Again, we mentioned prices, but what prices have a huge effect on that? The price of borrowing capital, the cost of capital, which is heavily determined by interest rates. So if you start tooling around with that signal, you're going to make it really hard to make accurate predictions. But if you're tooling around with the prices of goods through taxes, through tariffs, through regulations, etc., that will also, again, distort people's ability to make accurate predictions of the demands of tomorrow and the supply of resources to meet those demands and how to best put those resources together to meet those demands, etc. Okay? And then, so bottom line is, if you want the economy to grow, you want there to be better signals for people to make better predictions, which means you want market prices that are determined by true factors of supply and demand that reflect the true values of society, the true scarcity of goods and resources, and what's actually going on, so people can make predictions and make the economy grow. So let's get the government out of the manipulating prices game so that we can have a better environment for better market predictions, and a better economy for all. My name is Alex Merced from alexmerced.com. Have a great day and enjoy.